Hi there. Thanks for joining us here at PhillipCapital Market Watch. I'm Huan Zi, Branch Manager at Phillip Investor Centre, Toa Payoh. Today, I'll be sharing on some of the key takeaways from the US Federal Reserve meeting that was held earlier in January this year. The US Federal Reserve had their first meeting for the year on 25th and 26th of January. And the US economy is currently facing raging inflation that resulted in volatility in the stock market. In the face of potential actions by the Federal Reserve to rein in inflation, which is currently at its highest in nearly 40 years. The Fed policy-making group indicated that a quarter percentage point increase to the benchmark short-term borrowing rate is likely to take place in March 2022, which will be the first since December 2018, although widely anticipated. The Federal Reserve might also take a more aggressive path in its rate hike projections, which is speculated to potentially increase up to 5 times in 2022. Aside from the rate hikes, the committee also noted that the Fed monthly bond buying, which is proceeding at just $30 billion in February, is expected to end in March 2022, which is the same time the rate hike is expected to increase. The balance sheet is currently at nearly $9 trillion and expected to take some time to reduce without affecting the markets. The following will be some factors to consider. First, to understand the impact of the interest rate hike in inflation, interest rate hike will directly impact savings and loan rates, which will then lead to higher cost of loans while encouraging consumers to save. Although this might seem positive for the financial institutions, benefiting from higher net interest margins, it is generally a boon for firms with high debt levels, such as constructions, REITs, and also new growing firms. Increasing incentive for consumers to save will then lead to lower consumption of goods, resulting in a lower cash flows in the economy. This will then reduce the demand for goods and services in general, driving prices down on the assumptions that supplies will remain constant, achieving the Fed goal to rein inflation. However, the low cash flow in the economy, coupled with the Fed potential rollback of its balance sheets, would affect the liquidity of the economy, which will then result in volatility in the stock market and economy as well. Therefore, the Fed is currently navigating through troubled waters for the year ahead. I hope that you've enjoyed this episode of Market Watch. Do remember to like, follow us on social media, and subscribe to us on YouTube. You may also leave your comments to share with us your views and thoughts. Thank you for joining us once again.